Today's Real Vision Daily Briefing is brought to you by Chintai, your partner in asset tokenization. Licensed and regulated by Singapore's Monetary Authority and powered by the innovative Checks token, Chintai offers a compliant, one-stop solution for bringing real-world assets on-chain. Chintai enables the tokenization of virtually any asset, from carbon credits to corporate debt, private funds, and real estate, enhancing liquidity and optimizing efficiency for all.
The technology becomes largely invisible and seamless to the end user. I can take a selective store of value within a wider portfolio in a fairly liquid form very efficiently to anything, whether it's some high-value whiskey, whether it's a particular supercar that's a one of three limited edition, therefore in this fungible trading of them in a liquid form is the true end game here for tokenization.
With billions of dollars in client deals facilitated, explore how you can take advantage of tokenization by visiting realvision.com/Chintai. Did the Fed just pivot again? Hi, everyone. Welcome to the Real Vision Daily Briefing. I'm Maggie Lake. With me today is Darius Dale, founder of 42 Macro. Hi, Darius. How are you?
I'm doing well, Maggie. How are you?
I can barely speak because I'm just trying to keep up with what's going on here. What a day. I mean, the mood was very nervous going into the Fed. And then the Fed chair started speaking and we saw markets take off, stocks spiked higher, yields started to drop on what seemed to be a very surprisingly dovish pressure. And then the markets have given it almost all back now here as we close. I mean, we still have to settle up, but it seems to be a really sort of volatile reaction. What did you make of what you heard?
Yeah, absolutely. So thanks again for having me on the program as always. It's great to be here with the Real Vision community. So in terms of what we heard from the Fed specifically, obviously Powell went out of his way to send a dovish message to market participants. They're effectively not too fazed by the backup and inflation that we've observed on an annualized basis. But in terms of the market give back, obviously the rally that we saw on the statement and on the early innings of the press conference was in our opinion, obviously, shorter dated duration or shorter dated volatility products being covered, causing a gamma squeeze higher in markets. But once we got through that sort of that activity, the markets now started to look ahead and start to say, okay, was the Fed dovish enough today to fully and completely offset the hawkishness that we've seen week to date from the Treasury's quarterly refunding announcement? And clearly with this aggressive give back that we've seen in the stock market, the answer is no.
Yeah, they're not buying it, I guess, which is interesting in and of itself. So there was a lot going on in the presser, first of all, right? He said that it was very unlikely that the next move would be a hike. But then he also gave some details on QT and some of their posturing. I mean, it really seemed like they're trying to use the verbal messaging to try to fine tune this because they know that people started to really be thinking that we were going to start the day saying higher for longer. What happens now? Or, now what? We're like, wait a minute, that doesn't seem right. Anything that jumped out at you that was interesting, especially now that we have talk of QT easing up a bit as well?
Yeah. So in our opinion, I think it's important to kind of unpack the policy rate side and the balance sheet side separately. But just as a general overarching takeaway, in our opinion, this is a Powell Fed that is kowtowing to fiscal dominance, and this is a Powell-led Federal Reserve institution that really wants to ease monetary policy to the extent that they can. We're just not so sure that, based on the data, they're going to be allowed to, on a reasonable time horizon, to maintain the bullishness that we've seen in asset markets. So if you go to slide 10 in today's chart pack, Ryan, where we show the dot plot relative to Fed fund futures on various tenors and durations, and we see that, relative to where we were in March, we've seen Fed funds futures pricing back up in rate terms for 2025, 2024, 2025, 2026, and pretty significantly all the way out the curve until the floor Fed funds rate. So we are now only pricing in 2 cuts thereabouts for 2024, another 2 for 2025, not even a full cut for 2026, and then ultimately a couple more cuts down from there to the to the floor Fed funds rate at about 4%. So Powell did his best to sort of support that market pricing, that dovish market pricing, even though it's gotten more hawkish at the margins in recent weeks. And then on slide 11, Brian, where we show U.S. bank reserves as a ratio to various statistics in the economy: nominal GDP, total bank assets, total bank liabilities, and bank deposits. And as you can see, the blue line in each of those charts, the ratio of bank reserves to all those indicators has not only stopped going down, quite a long time ago, almost a year and a half ago, but they've been gradually trending higher. Really, as in my opinion, as a function of what had been pretty dovish net financing policy out of the Treasury. And so the fact that the Federal Reserve here, with annualized inflation running at some pretty ridiculously and egregious levels, following the heels of a very hawkish ECI print that we got on Tuesday, the fact that the Federal Reserve is trying to slow balance sheet runoff, they're gonna reduce the balance sheet runoff pace for Treasury securities to 25 billion a month from 60 billion a month, while maintaining mortgage-backed runoff at 35 billion. The fact that they're doing that in the face of a pretty resilient economy and increasingly resilient inflation, to me, again, goes back to this idea that this is a Powell Fed that wants to kowtow to fiscal dominance and create monetary space for the fiscal authority to continue supporting the economy.
Yeah, I mean, so and this issue has come up. In fact, we were talking to Miss Schneider yesterday, and we had the market selling off, and she pointed out that part of it was also about Yellen talking about all the things she was worried about. I want to run a clip. Ash just had a great conversation with Scott Bessent, longtime macro, managed and worked with George Soros for years, runs his own hedge fund. He just talked to him about they had a wide-ranging interview, but this issue of the debt situation in the U.S. came up. Let's have a listen to what he said, and then we'll talk on the other side.
Yellen is trying to goose the economy. He's a political appointee. And, I would say she has gone from public servant to apparatchik. And she is playing a lot of games. And she has shortened the debt maturity. So not only do we have these gigantic deficits, what is exactly the wrong thing to do is to move the maturities to the short end. So now that the U.S. is becoming like an emerging market, we are rolling 90-day Treasury bills. And this goes back to, I believe that she and Powell thought that they would be cutting rates now. And obviously, this was a terrible miscalculation. The Fed failed the American people with the great inflation of 21 and 22. They were very late getting to hiking rates, and kind of in the ultimate absurdity is they were doing QE right up until the month before the first rate hike. So, but anyway, that was a long way of saying I think the markets, we're seeing this back up in yields. We've seen gold move up versus the dollar, and we are in a very unstable position now.
Really fascinating interview. If you want to see that entire conversation, they touch on a really wide range of topics. Just go over to our website and check it out. And if you are not a member, join so you can see this kind of great stuff, long form stuff that we don't often get to see or hear from, especially folks like that. Obviously, a little politics in there. And, Yellen is at Treasury. Part of this fiscal dominance is, of course, comes from Congress. It's not Treasury, right? If you all do your civics class, Congress is the one who passes the bills and that increase the deficit, whether they want to admit it or not, which is what they're trying to fund right now. But that aside, he brings up some really good points, Darius. And I think that this is one of the issues that, and there are two of them, that we're getting to the point where there's a question mark as to whether you can increase rates when you've got these debts and service that amount of debt. And this press conference, I think, plays right into that idea. In fact, there was a great tweet, I think it was by Sven Heinrich, who said that Yellen needs lower rates and she knows it, and so does the Fed. That this is this is basically coordinated action to keep liquidity flowing and to enable further debt sales without accidents, basically putting a ceiling on yields, that sort of idea. The other issue I think that Scott brings up, which is super important, is does the market go along with it? Right? I mean, like the market has to have confidence in all of this. And if they think that inflation's a problem, then you get that sort of bomb vigilante stuff going on where the market's going to do what the market thinks is right. And they're not going to really pay attention to what the Fed's saying. So how are you thinking about all this? Because these are really big themes.
Yeah, I appreciate that, Maggie. So I've known Scott pretty well for a long time, and he and I fundamentally disagree on this. In our view, the Treasury is moving further away from financing itself in the bill market, as we got the indication from in the Q2 QRA. Brian, if you throw up slide 4 in today's chart pack, where we show the share of net marketable borrowing in the bills market and the coupon market, and as we see, we're going into heading into Q3. The 34% share of bills on a trailing 12-month basis through Q3 of this year will be the lowest share of bills since the first quarter of last year. And so the Treasury is moving further out on the curve in terms of its net financing policy. And in our opinion, she's doing that explicitly to send a hawkish message to market participants for two reasons. One, Brian, if you go up slide 7, where we show the spread between market observed interest rates relative to their various counterparties on the Treasury curve in segment terms, and we see that if you look at the bill market relative to where the bill yields are in the market currently relative to the Treasury's weighted average interest rate on bills, that is the only segment of the Treasury market where the Treasury is actually getting a discount to issue. So the fact that she's issuing less bills at the margins on a share basis, in our opinion, is an explicit hawkish signal. And then number two, on slide 8, we just don't see the same kind of rollover refinancing risk in the Treasury market that Scott alluded to. When you sort of think about the average maturity of total outstanding marketable debt, here we show on slide 8 in the top panel, is 71 months. It's almost at an all-time high. It's essentially at an all-time high. If you look at it in terms of the percentage of marketable debt that's maturing in the next 1 year, 2 year, and 3 years, that's 34%, 45%, and 54% respectively. And each of those shares is lower than its long-term mean. And so this is a Treasury market that over the last, let's call it 10 to 15 years, has really termed out its portfolio and taken advantage of what was a historically low era of interest rates to term out its debt portfolio, and is now moving in the other direction on a structural basis. But on a cyclical basis, i.e. what we just learned this week from the QRA, which calls for Treasury debt issuance on a net financing basis to increase to $847 billion from $243 billion in Q2 to $847 in Q3, and also an increase in the Treasury general account balance by $100 billion to $850. Those are very explicitly hawkish signals, and she's doing it in a composition manner that suggests that we could see some indigestion in asset markets if Powell is forced by data to get less dovish. And
wouldn't he have been forced by data to get less dovish now? Because granted, we've seen some of the economic indicators, consumer confidence, some of the PMI readings looking terrible, but the inflation, most of the inflation data has been coming in above expectations. We had the employment cost index this week. Are we getting a wrong signal from some of that inflation data? I know some of it's forward looking, some of it's backward looking, and there's a discussion about that. Wouldn't you have thought, based on that, he knew that there would be this response today by doing this? He knew that, but I mean, the markets are not following through, but one could have presumed that you would get a big rally. So, how do you think that's playing out? And do we have it wrong? Does the market have it wrong about inflation?
No, so in my opinion, I don't think the market's ever really wrong. It's just, there's positioning cycles you have to deal with. And so the unwinding and building up of positions causes the market to have awkward prices at different times, but the market's never wrong. It's the market. But let's get back to the question. So in our opinion, Powell is the last line of defense between hawkish inflation data and hawkish developments in the economy from a forward-looking perspective, which are separate, and a more hawkish overall pivot by the Federal Reserve. So let's kind of unpack a few of those things in succession. Brian, if you go up slide 14 in the chart back today, where we show the headline PC deflator, the core PC deflator, and the super core PC deflator on a 3-month annualized rate of change basis in the blue bars, 6-month annualized in the black line, and the year-over-year in the blue line. What we see here, if you look at the bottom, we've seen super core PCE inflation on a 3-month annualized rate of change basis is now back up at the highs that we observed in 2021, 2022, and early 2023. And we are now having what we call a textbook acceleration, whereby the 3-month annualized rate of change is faster than the 6-month annualized rate of change, which itself is faster than the year-over-year rate of change, which implies the date time series may be bottoming from a structural standpoint. Number two, so that's the backward-looking data. The forward-looking data, you obviously mentioned the ECI print that we got on Tuesday.
Mhm.
Employment cost index on the private sector side of things accelerated to 4.4% on a quarter-over-quarter SAR basis. That number is 200 basis points faster than its 2015 to 2019 trend. So we are in no man's land with respect to wages. But the final thing I'll call up from a forward-looking perspective is that what Powell sort of alluded to today, which in our opinion is the number one reason why he still is so dovish, is the quote unquote healing of the supply side economy that he highlighted. So Brian, if you throw up slide 12 in this chart, we show non-farm productivity growth on a quarter-over-quarter SAR basis and on a year-over-year basis in the bottom panel. As you can see in both metrics, both time series, we are well above trend in those time series. Now, we're going to get productivity at 8:30 tomorrow morning. And the early read-through is that productivity growth should have slowed pretty materially, just given that we've seen a pretty big back up in hours worked and a pretty big reduction in overall output in GDP terms. And so productivity growth slows, if we show on slide 13, that's going to be an issue from a forward-looking inflation signaling perspective, because we know that whenever wage inflation materially outpaces productivity growth, as we show here in this blue line here, that's the spread between wage inflation and productivity growth, you tend to have these big backups in actual inflation, like CPI and core PCE, those the black line and the red line in those charts. So if productivity growth goes down and wage inflation stays where it is or continues to get hotter, then that would be a forward-looking indication that some of the stickiness that we've seen in reported inflation statistics over the past few months is not just this transitory blip. We're just settling in at a much higher structural level of inflation, and ultimately Powell will be forced he'll be dragged kicking and screaming into pivoting back to a higher for longer guidance.
Mm.
And that's what markets are probably latching onto, is that if we start to see less supply side improvement, Powell may be forced to pivot. In our opinion, that'll be a very ill-timed pivot in the context of those quarterly refunding signals.
Why? So they could have just said almost nothing today. They could have just left it. They seem like they were taking inflation more seriously. They haven't removed their easing necessarily from the forecast. They were sending out trial balloons saying we may have to hike, actually, when the market seemed to have been too confident about those easings. They kind of got the market back on equilibrium and worried again about inflation and inflation expectations. So why introduce all of this confusion, I guess? Do you think they are worried about the economy, or do you think there are a lot of people? I mean, you know what Twitter's like, and everybody wants, like we all have to take a step back and walk through this. But do you think that they're worried about liquidity in the treasury market, that they did want to, without doing straightforward yield curve, they did want to sort of somehow put some sort of broad ceiling or at least slow down the increase on yields?
Yeah, so I think when you take a longer term view on this, Maggie, and this is something we've talked about in the context of our secular inflation model over the past few years. When we look back on this period, let's call it 3 to 5 years from now, in our opinion, we think one dynamic will be very clear, which is the Federal Reserve, rather than go the last mile of disinflation to get inflation sustainably back to 2%, opted to save the economy rather than achieve its inflation mandate. When faced with the choice between achieving its price stability mandate or its maximum employment mandate, we think this Powell Federal Reserve will most certainly choose its maximum employment mandate. And ultimately, that is structurally bullish for the sustainability of the business cycle, which itself is structurally bullish for risk assets, but it's obviously structurally bearish for things like the bond market and perhaps the U.S. dollar as well. Now, that doesn't necessarily mean risk assets are going to appreciate in a straight line from here, or defensive assets like treasuries and the dollar and volatility products are going to depreciate in a straight line from here, because again, it's all about where you are in this market cycle. Positioning has gotten way extended, and we may be headed into a period where the supply side improvement in the economy stops improving for a while. That causes Jay Powell to change his tune and really stop being as supportive in terms of forward guidance for asset markets. And that is a big risk. And in my opinion, I think the give back that we saw in the markets today very much agree with our fundamentally oriented view here.
So Boris is asking, you just mentioned positioning. Do you have any insights into the current positioning of investors with regards to bonds and equities? There's been a lot of talk about the 60-40 being broken. And so, what do you do if you're worried about valuations of on equities, but you've got this continued volatility in the bond market? What are you seeing in terms of positioning?
Yeah, it's pretty stretched. I mean, so in our positioning model, we track upwards of 10 indicators that all have time series back, multiple market cycles, some with the furthest back, into the late 70s, early 80s. And when you think about this on a tactical standpoint, we've seen a little bit of a reduction in net long positioning across markets. So that lessens the need for a pullback over the very immediate term. But when you think about this from a structural standpoint, the more stable, stickier positioning indicators are still very much signaling elevated risk of a market crash over the long term. And so that's something that's quite worrisome in the context of, again, the Treasury is very explicitly, in our opinion, trying to tighten financial conditions, and perhaps with the expectation that they can sneak in a few dovish inflation prints between now and the election. But if that does not happen because we stop seeing the supply side improvement in the economy, particularly on the productivity front, then the Fed may be forced to start to tighten financial conditions again as well. Rhetorically, they're obviously not going to hike interest rates anytime soon, but just pivoting back to explicit higher for longer forward guidance with the dot plot and with their words and actions, very well could cause funds to flee back onto the Fed's balance sheet in the form of the reverse repo facility. We show that on slide 9, Brian. You could cause a sort of a unwind of a lot of the positive liquidity dynamics that have really aided and abetted asset markets, not just from the October lows of last year, but really all the way going back to since the October lows of 2022.
Yeah. So, Chris A asking, have we started to enter a risk-off regime for growth stocks in crypto?
That's a great question, Chris. Yeah, unfortunately, got to be a 42 macro client. See, this is. I want to make a quick shout out here. I'm happy to explain all these sort of critical growth, inflation, and policy dynamics because I think I'm really grateful for the opportunity to educate folks on this esoteric institutional finance stuff. But when it comes to making and saving money in asset markets with explicit guidance and explicit portfolio recommendations, that stuff's reserved for our clients at 42 Max.
Yeah, which we respect. So, when we see something like this now, Darius, do you have to go back and recalibrate everything based on, or are you just sticking with your signals and this is just sort of market noise in what is a bumpy period we're in?
What I will say is that this is not just market noise because the change in market signals that we've observed in the past sort of month or so, if you throw up our macro weather model on slide 2, that's one of our more important leading models that gives us an indication of how the market regime might evolve over the next 3 months. It doesn't tell us if the market regime has evolved, but it will suggest that, hey, we might be in condition A, and the probability of remaining in condition A over the next 3 months is increasing or declining. So I would say the probability of remaining in condition A, which is a risk-on regime, as evidenced by the composite signals here in our macro weather model, which we refresh 6 days a week for our clients, the probability has declined pretty meaningfully, and it's declined based on fundamental reasons that are being captured by those cycles, the real financial economy cycles that are being scored daily in that model. If I could think about this from a thematic perspective, so that's on the quantitative side in terms of how to anticipate regime change and actually, more importantly, position for regime change so you can actually make money in financial markets. On the qualitative side of things, we have seen some significant change in our themes. We sort of heading into this week, one of the themes that have been more bullish for asset markets, particularly again since the October lows of last year, is this concept of Jay and Janet wanting a soft landing. That was one of our themes that, in our opinion, died this week with the quarterly funding announcement. You go back to late October of last year, the quarterly funding was extremely bullish, and Waller created the Fed pivot, and both the Fed and the Treasury kind of kept that up, through Q1 of this year, and now that's changing at the margins with the quarterly refunding announcement, the Q2 quarterly refunding announcement. The Fed is not there yet. Jay Powell is trying his best to stay as dovish as he possibly can, but again, you have to be concerned with the market signaling today in terms of the intraday reversal and nasty close that we saw. Is that the market might be saying, okay, Powell might not be able to remain as dovish and maintain credibility in the coming months, particularly if some of the leading supply side dynamics in the economy start to move in the wrong direction again, and they very much will. And again, we get productivity tomorrow at 8:30 a.m. Eastern.
Yeah, and you've been talking about that. That's been super important. Any feeling about where we are with that? Because if the productivity is high, it changes things, right? But if we start to see that move lower as well, that can't be a good thing.
Yeah, absolutely. You're spot on, Maggie. So none of us as economists, now putting my economist hat on, none of us understands how to forecast productivity. I've not seen any good models that can do that with the consistency. So the reality is we're sort of at the we're at the mercy of the data and the unfolding of the data. That's sort of kind of how we have been in this business cycle broadly. If you look at the forecast error for consensus estimates on growth and inflation, it's been as wide as we've ever seen in those time series. So the reality is a lot of models have broken in this post-crisis era, which is something you and I've talked about, Maggie, on this program. A lot of models have broken, and so we as investors we've had to make our processes less reliant on prediction. Those investors that have done well in the past few years have had to make their processes less reliant on prediction and more reliant on observation. And I think we do a pretty good job of that here for our clients at 42 Macro.
Yeah. So you had been tracking how resilient this US economy is. We just came through earnings. If they're not trying to engineer a soft landing, is this just end? Do we have to have a recession? Is that the end game here?
In our opinion, again, we the only way to get inflation sustainably back to 2% or even anywhere close to that, in our opinion, is a recession. However, from a longer term thematic standpoint, we do not believe the Jay Powell Fed is willing to push the economy into a hard landing in order to satisfy its price stability mandate. And so again, that's structurally bullish, but it doesn't mean it has to be bullish from May 1st of 2024 through October 31st of 2024.
Right.
That
This is
is
timing.
It's just timing, exactly. So you got to think about, and something we talked about as well for every institutional investor would know what I'm about to say, but retail investors, perk up and listen to this. When you think about organizing the risk across your portfolio, obviously most people think about diversification in the context of I'm among this factor, I'm among that factor, and these things should be reasonably uncorrelated. But the reality is most things are highly correlated in any market downturn. However, you can diversify your bets across themes and investment horizons. All of your positions don't have to correspond to the next, let's call it 6 months or the next year or the next 3 years. You can have different tranches in your portfolio that correspond to different horizons so that you create a little bit more non-correlation, when you're talking about entering and exiting trades. That's one way to think about managing risk. Obviously, spreading your bets across different themes can be helpful as well, but you have to be careful, obviously, if your themes, how you have to understand how correlated your themes might be in a market decline.
That's a really great point because people do tend to think of it more narratively and they do say, well, if I've got, energy, I'm going to think about tech as non-correlated, but time frame wise, and you all know when we talk to Raul, he always says, and people forget this, he's super long term. So he is just thinking about these very long mega trends most of the time. In fact, we're going to have a conversation around the exponentialist and talk some tech tomorrow with he and David Matten and Imran and bring some derivatives talk into that. So everybody should roll up for that. That'll be on the DB tomorrow. But having stacking that with some short term and long term and medium term and thinking about it in terms of time horizon. We say that when you're thinking about when you need your money, but thinking about that as a way to diversify, Darius, is really interesting. And I don't think most people think about it that way. They tend to think assets.
Yeah, a lot of people think about asset allocation. We think about portfolio construction here at 42 Macro and try to help our clients with that. I think we do a pretty good job of that.
Well, how are you? Anything on your radar globally? Because we have a lot of concern and talk about China. We've seen a lot of pressure on some of these currencies. A lot of talk about devaluation. We have the Bank of Japan maybe intervening, but not very convincingly. A lot of action on the yen. Anything internationally that's on your radar?
Yeah, absolutely. So one of the things I think is important to remember as investors that, especially on a week like this where you're getting bombarded with a lot of new information, particularly market moving information, it's easy to forget the other themes that still exist. And two of those other themes that still exist are our China frontloading stimulus theme and our green shoots globally theme. Brian, if you throw up slide 3 in our chart pack today, where we show our refresh global liquidity model. This is another tool that we refresh for our clients 6 days a week here at 42 Macro, which shows the delta and the trend and the level across all the major growth, inflation, and policy indicators for every major economy in the world. And I'll divert your eyes to the second grouping of columns where we show the composite PMI trends for every major economy in the world, and they are trending higher for every major economy in the world. So the global economy continues to heal, albeit slowly, but is moving in the positive direction. We continue to see economic disappointment in China, which suggests the PBOC, which has been handed the baton by Beijing to support the economy, is likely to keep its foot on the gas. And so those things haven't gone anywhere just because quarterly refunding announcement was hawkish or because Powell doubled down on being dovish. Those things are still existing in existing. So you have to think about having a thoughtful, balanced process that can sort of understand the full distribution of economic outcomes in order to construct and more importantly, deconstruct portfolios whenever you have regime change in asset markets. So definitely make sure that you're either paying attention to everything all the time or you're paying someone to pay attention to everything all the time for you, because that's the
Right.
only way, in my opinion, you're going to consistently outperform in asset markets.
Yeah. Listen, these are complicated times right now, and I think especially because we have had so much action on the rate side, and everyone's trying to figure out what to do, and there are mixed signals. And I feel you, Adam, because Adam posted in the chat. I'm more confused now. If we have to think about a takeaway from today, or a thought to leave people with, Darius, what would it be?
The takeaway from today is that Powell wants to do his best to mitigate the financial conditions tightening that the Treasury is pushing through with this revised net financing policy. However, from our forward-looking perspective, and this is Darius Dale, the investor, talking. I don't know that Powell will be able to maintain that dovish bias if we continue to see a lack of improvement on the supply side of the economy. One of the things that caused the soft landing trade that our clients benefited from since the beginning of November, in our opinion, was the obvious improvement in this in the supply side of the economy. If that improvement stalls out, or more importantly, starts to go in the wrong direction, as it started to earlier this week with the ECI, could go in a significantly worse direction tomorrow with the productivity numbers, then Powell won't be able to credibly say things are getting fine, don't worry about it, in our opinion. And you're going to start to see inflation stabilize at these very elevated levels, which ultimately means that no matter what Powell says, asset markets, money markets will start to price in higher for longer, and pricing in higher for longer in money market terms causes the reverse repo facility balance to go in the wrong direction in the context of the net financing policy that we're seeing out of the Treasury, the more hawkish net financing policy we're seeing out of Treasury. So it's, I know everyone wants a definitive answer, but you don't always have to have definitive answers. This is why we build a sophisticated quantitative risk management systems.
Yeah.
Those systems, when and if they pivot, and I'm not telling you if they have pivoted or if they won't, if they are going to pivot, but if they pivot, that's when you need to do something different in your portfolio, because again, you understand the full distribution of outcomes. If you're only focused on one side of the distribution, you're going to be at best agnostic to the pivot, or at worst, you're going to fight the pivot. And that, in my opinion, is how you blow yourself up as an investor.
Yeah, no, great. Can you just, before we go, explain why was that uh refinancing, that quarterly net, why was that hawkish in your mind for people who
Yes.
don't follow that? Because I think that's where he's trying to offset something she did, but you hear, especially if you go on Twitter, it's like Yellen's juicing the economy. I mean, we had Scott say that. So, there's this sense that Treasury's trying to, get the, get juice the economy ahead so Biden gets the election, whatever. So why did you, because this is an interesting thing for us to pay attention to. Why is it hawkish?
Yeah, so in our opinion, it's hawkish because the share of coupons relative to the total net financing is rising over time. We mentioned that the share of bills, going back to slide 4, Brian, the share of bills on a trailing 12-month basis through Q3 of 2024, which is the furthest we have a projection for, will decline to 34%, which is the lowest ratio we've seen since 1Q of 2023. If you want to put some numbers on this, if you look at the coupons, we're going to go up to $557 billion in coupons in Q3. That's the highest number we've seen since 4Q 2021. If you want to look at bonds, we're going to go up to $184 billion in bonds, net bond supply in Q3. That's the highest number we've seen since 2Q 2022. So we're moving in the wrong direction in terms of coupon supply and bond supply. We're moving in the wrong direction in terms of bill supply. And more importantly, going back to slide 7 and 8 that we talked about earlier, there's no economic reason to do that from either a cost perspective or refinancing risk perspective. So in our opinion, the only reason she's doing this is to tighten financial conditions and try to get a few slower inflation prints ahead of the election, because that's obviously a hot button issue for Biden on the campaign trail.
This is why we got to dig in, people, because it's easy to get confused on the headline. But I think that that's really interesting, Darius. And if you want to understand a little bit more, grab that and stick it in the AI tool on the platform, and it'll sort of really help you think that out, because there's a lot of cross currents we have to pay attention to. So fantastic stuff. Darius, thank you so much. Always great to catch up with you, especially on a day that turned really volatile, as you said. And Christopher noted in the chat, really ugly at the end. So fasten your seatbelts for tomorrow. You never want to see a day end with a lot of bearish activity like that. So everyone's got to sleep on this and try to figure it out. So it's going to be an interesting day. So thanks.
Appreciate you,
Appreciate it.
Maggie. And I will say one thing. Someone who uses AI on a regular basis, and increasingly so, AI is a long way away from being able to connect the dots like we do humbly.
Oh, of course. Of course. We're talking definitions for those of us who are trying to keep up.
You'll get some definitions, but you're not going to get this kind of
no forecasting, just definitions.
No.
But it does help because obviously
I will be replaced by AI someday, but in our opinion, that's a long ways away.
Hell, we might all be, but we're not going to go down without swinging. So, but yes, but just from a definition point of view, when you're thinking about things like, you guys all know how those mechanics work, but not everybody does. So, it's helpful for that. So, but fantastic stuff. We'll see what's ahead. And Darius, we look forward to catching up with you again. Thanks so much.
Thank you, Maggie. Appreciate you guys. Thanks again.
Thanks. And hey, just a note for everybody. I think we're coming up on the deadline. We have a crypto product. And I don't know if you saw the Real Vision tweet today, but we talk about both sides, right? You got to be educated about all assets, whether you want to own them or not own them and say no, or short them or buy them. So, this is an education and this is the early beginnings of this brand new asset class. So you want to know what you're talking about, even if you want to be a bear. It is RV Crypto. It's going to be trade ideas, risk management tools, and in-depth research without getting into sort of the weeds for those who are already more advanced on the journey. So there's a special discount now. It's at realvision.com/RVC. So go check it out. And we will see you all tomorrow for Rylan, David, Matt, and Imran. We hope you join us then. In the meantime, take care and good luck out there. Today's Real Vision Daily Briefing is brought to you by Chintai, your partner in asset tokenization. Licensed and regulated by Singapore's Monetary Authority and powered by the innovative CHEX token, Chintai offers a compliant, one-stop solution for bringing real-world assets on-chain. Chintai enables the tokenization of virtually any asset, from carbon credits to corporate debt, private funds, and real estate, enhancing liquidity and optimizing efficiency for all.
The technology becomes largely invisible and seamless to the end user. I can take a selective store of value within a wider portfolio in a fairly liquid form very efficiently to anything, whether it's some high-value whiskey, whether it's a particular supercar that's a one of three limited edition, therefore in this fungible trading of them in a liquid form is the true end game here for tokenization.
With billions of dollars in client deals facilitated, explore how you can take advantage of tokenization by visiting realvision.com/Chintai.